Hi, folks. Welcome to this episode of the Retire Happy Money Minute. Today, I want to talk about the bear market. The first 6 months of 2022 have been the worst first 6 months in over 50 years. A lot of people who are invested in stocks or thinking about investing in stocks are feeling kind of lousy right now. We've got the NASDAQ down over 30%. We have the S&P 500 down over 20%. These are bear market readings. There are many stocks down more than 50%. And the Dow Jones is down 15%, which is correction, but technically not a bear market. So a lot of people feeling kind of bad, where last year everybody was really excited. Now, not so much. So let's really put this in perspective for you. Okay, first of all, we are in the second year of a new president's first term. Historically, this is not a very good year. Clinton, 94, was up 1.33% in his second year. Now, remember that beyond that, we started getting 20, 30% returns for the rest of that decade. 2002, under Bush, we were down 21.97% on the S&P 500. In 2010, under Obama, we were up 14.82%. But when you bracket that with some of the other returns around that, it was a lesser year. In 2018, under the Trump administration, down 4.38% in 2018 on the S&P. And, of course, we're down, as I indicated earlier, in the first half of this year. Now, when you stop and take a step back, it feels lousy, I understand. And the hardest thing in the world is to get enthusiastic about markets like this and making investments in it. I mean, I remember back in my early years of brokerage, people would say, well, that sounds like a good investment, but I want to watch it. And I'd ask, well, what are you watching for? And they say, I want to see if it goes up. But logically, if it goes up, it's already gone up. It'll be much harder to make money after it goes up, right? And so I want to remind us of a few of these basics. Number one, when we invest, that rule of buy low, sell high makes a lot of sense intellectually. But it gets very hard because we have this thing called immediacy bias. We think whatever's happening right now is going to keep happening. And when I monitor headlines on Bloomberg or MarketWatch or in the Wall Street Journal, there's lots of articles right now saying, oh, it's going to get worse. It's going to go down another 50%. Oh, it's going to go down. The Dow Jones will make it to 10,000. Oh, my goodness, it's never going to come back. Oh, no. Well, last year, about this time, if you'd have been looking at the headlines, Dow Jones is going to 50,000. NASDAQ stocks are, have a tailwind and they're going to keep rising. All of these kinds of things were coming out, and you got to get in, right? So it's that notion that it's just going to keep going in whatever direction it's going in. But logically, every time it goes up, it's going to come down at some point. And you might have noticed when things go down, it doesn't matter what they are, whether it's a building being imploded or stocks, they go down faster than it takes to have them go up. It takes longer to build a building than it does to bring it down using explosives, for example, or even a sledgehammer. So let's look at what happens in the 12 months after we see a 20% or more correction in the first half of the year, or really at any time. So if we go back to World War II, we've had 12 of these periods. And according to Mark Hulbert of the Hulbert Digest, a gentleman who I've followed for many years, the average after the S&P goes down by 20%, that's the definition of a bear market. The average returns in the following 12 months are 22.7%. Not bad. I know I'd be happy with that. Now, this doesn't happen 100% of the time. It's happened 10 out of the 12 times we've had a 20% correction since World War II. Pretty good odds. It's better than 80%. But even those other 2 times, because you were buying at a discount to the valuations that had existed prior, you ultimately ended up higher. So if you're a long-term investor, you might want to consider expanding your participation in the market at these kinds of levels just because of that. I encourage you to talk to your financial advisors about that. And, buying that day after we hit 20% has been a really good strategy. The other thing to remember, as I mentioned earlier, that second year of the first term of a presidential 4-year period is pretty lousy. Well, the third year tends to be really great. In fact, statistically, it's the best of the 4 years of that term. So just try to take a step back, keep your perspective. This will help reduce stress in the long run, help improve your returns in the long run. And if you want to talk about this, we have a lot of research that we've been doing about this topic. Feel free to give us a call here at the office. Go to www.gainerfinancial.com and you can send us an inquiry. We'll get back to you. And if it's still hard to take these positions, we have some opportunities and options that will protect you from the downside. If, like those 2 out of 12 years, it continues to go down, we can put a floor and make sure that you don't lose money if it continues to go down, but still participate significantly in the upside of what's happened most of the time after these kinds of bear markets. Here's to you having a very happy retirement. Take care, and we'll see you next week.